Hello, John Gillespie here today with Occam's Investing. Today I'm going to run you through a valuation for a company named Advanced Micro Devices. We're going to use the discounted cash flow. And let's see, so the DCF comes back as a sell, confidence high, and that's really a function of the market has been really big on AI lately, and semiconductors especially. So right now is at a current price of $220. The intrinsic value is a little less than 74. So based on the DCF, it's coming back as a strong sell. We tell you our assumptions based on its cash flow. The Occam score is healthy. And then we start getting down to the AI analysis so that you have a better understanding whether you should just go with a DCF or if you should run a peer relative value review to learn a little bit more. But in any case, the AI analysis based on Peter Lynch's categories, AMD is a fast grower. It meets 6 out of 7's Buffett's metrics. Based on my risk profile, it's set as a buy, and we would size our positions based on our conviction to the story. So our little card here, what would Buffett do? This is close but not clean. Buffett would want net margin greater than 20% to pass before he committed. So in a nutshell, based on the DCF and Buffett and Lynch, it's still a sell. Occam classic cash flow is healthy. Growth is almost 20%. We'll get down to the AI valuation narrative. This is where it starts to get very interesting because typically you're going to get an analyst buy, sell, or hold, and maybe you get a little narrative from them, but it's one person's view of the world. Remember Professor Dematarin at NYU, for valuation classes, he would start off and say, when you're developing your valuation, come up with your thesis, and it's your story. When you develop your model, stick to your story, which means people come up with what they want it to do, and they develop a model to kind of prove what they're thinking. So in any case, the AIs come back, and they say AMD has transformed itself from a perennial underdog into a formidable competitor in the semiconductor space, particularly in CPUs and GPUs. The company's recent strong demand for its data center processors, consumer CPUs, and GPU products competing against NVIDIA in AI and gaming markets. The company has successfully gained significant market share from Intel in the CPU space while building a credible alternative in the GPU AI accelerator market. With $6.7 billion in free cash flow generation and a stellar Rule of 40 score of 56.6, AMD demonstrates both cash and profitability, a rare combination in today's market. However, the current valuation appears to price in perfection and then some. At $220 per share versus a DCF intrinsic value of 74, the stock trades at nearly 3 times its calculated fair value. While 19.87 perpetual growth assumption in the DCF might seem reasonable given recent performance, it's extraordinarily optimistic for a cyclical semiconductor company facing increasing competition from NVIDIA, Intel, and Intel's resurgence efforts, and a potential market saturation of key segments. And I can second that, as I more than once have been caught up in the tidal wave of both NVIDIA and AMD's losing a step with the market, their gross margin going down, and the price cratering, and then holding on to the stock for another cycle. I've made money, because I held on. But if you had to sell during the low part of your cycle, you would be crying without a doubt. So the valuation assessment. The DCF growth assumptions appear aggressive when contextualized against semiconductor industry cyclicality. While AMD's recent execution has been exceptional, assuming 20% perpetual growth for a company in a notoriously cyclical industry stretches credibility. The forensic scorecard shows pristine fundamentals, an Occam score of 100, but this healthy operational performance does not justify the current price premium. The forensic signals strongly support AMD's operational excellence, no zombie characteristics, minimal divergence between earnings and cash flow, and robust cash generation. However, these positive fundamentals don't override basic valuation discipline. The 66% negative margin of safety suggests the market is dramatically overshot reasonable valuations, even accounting for AMD's competitive position and growth prospects. So for signal reconciliation, I trust the forensic signals regarding the operational health. AMD is clearly a high-quality, well-managed company generating real cash flows. However, I also trust the DCS valuation warning. Quality and price are separate considerations, and AMD represents a classical case of a great company at an expensive price. The forensic health score validates AMD's business model and execution, while the DCF appropriately flags valuation concerns. Both signals can be simultaneously correct. The conflict isn't between methodologies, but between AMD's fundamental strength and its market valuation. This suggests a wait for a better price scenario, rather than questioning the company's prospects. So the final verdict here is a sell, right? So following is some market sentiment, and it doesn't override the forensic analysis. So do not, my recommendation is do not get caught up in the excitement of the AI market unless you can risk holding on to a stock like AMD for a long period of time. Yes, you might make money, but it can easily turn on you, and if you have to sell, then you'll be losing.